Welcome back to Today Assets Report, the channel where we cut through the noise and give you the analysis that actually matters before the crowd figures it out. Today, we are diving deep into one of the most important conversations happening in the crypto space right now, and it centers on a number that most XRP holders have never seriously thought about. Not the price you see on your screen, not the market cap that gets thrown around in every YouTube thumbnail. We are talking about the functional price requirement, the number that XRP actually needs to reach in order to do the job it was built to do at a global scale. And here is the headline that should be stopping you in your tracks today. XRP must be $100 or higher to succeed. And this is not speculation. This is not hopium dressed up in a suit. This is the math. And once you understand it, everything you thought you knew about XRP's current price is going to look completely different. So stay right here because this one changes the way you see the board entirely. Voice. Host. Let us start with the problem that almost nobody in the retail community is talking about, and that is the metric everyone keeps using to evaluate XRP, market cap. Now, market cap is a useful tool when you are looking at companies. It tells you what the market believes a business is worth right now based on shares outstanding and current price. But XRP is not a company. It is not an ownership stake in a revenue-generating business. XRP is a liquidity instrument, a bridge asset designed to carry value across borders at institutional scale and speed. And when you try to evaluate a liquidity instrument the same way you evaluate a tech stock, you are using the wrong measuring stick entirely. The institutions that are quietly building their XRP positions right now are not pulling up a market cap chart. They are running a completely different calculation. And that calculation is asking one question above all others. Can this asset carry the load without destroying the transaction through its own volume? That is the real question. And the answer to that question is what drives the functional price requirement that most retail investors have never even heard of. Voice. Host. Here is the best way to understand why price matters for a bridge asset in a way that it simply does not for a stock. Think about gold for a moment. Gold is priced in the thousands per ounce, not because someone arbitrarily decided it was worth that much, but because gold needed to be dense enough in value to carry large transactions without requiring you to physically move truckloads of metal across borders. Value density is not a luxury for a global reserve asset. It is an engineering requirement. You cannot build a functional global settlement system on a cheap asset because cheap assets cannot absorb volume without creating catastrophic slippage. XRP is solving the exact same problem that gold solved, except it is doing it in the cross-border payments market, a market that moves over $150 trillion every single year through infrastructure that was largely built in the 1970s. We are talking about SWIFT, a system that is slow, expensive, and structurally incapable of handling the transaction volumes that are about to hit global finance as tokenization and digital payments continue to scale at an accelerating pace. Voice. Host. Now let us get into the math, because this is where things get real, and this is the part that most people have simply never seen laid out clearly. Start with a single transaction. A company wants to move $10 million from a U.S. bank to a supplier in Singapore. At XRP's current price, around $2, that transaction requires approximately 5 million XRP tokens to complete. That is manageable for a single trade on a good day with decent liquidity conditions. But now scale that up to what a Tier 1 bank actually processes. JP Morgan alone moves roughly $10 trillion in wholesale payments every single year. If the XRP ledger captures just 3% of that volume, you are looking at $300 billion annually running through a token priced at $2. The slippage on that volume would be absolutely catastrophic. You would be moving the market against yourself with every single transaction, and institutional trading desks run these models before a single dollar is ever committed. They already know what $2 XRP cannot do at scale, and that knowledge is what is shaping their positioning right now. Voice. Host. Here is the compression theory explained simply, and once you hear this, you are going to understand why institutional players are not waiting for the price to pump before they enter. They are engineering the pump from the demand side. At $1,000 XRP, moving $3 billion requires only 3 million tokens. Clean, efficient, minimal slippage, operationally viable for an institution that needs to move that kind of money repeatedly throughout a trading day. At $2 XRP, moving that same $3 billion requires 1.5 billion tokens, and the friction generated by sourcing and moving that volume destroys the economic value of the transaction itself. This is not a speculative framework. This is basic liquidity mechanics that every institutional trading desk in the world understands deeply. The price has to be high enough to carry the load without breaking under the friction of its own volume. That is the functional price floor, and it is not something the market sets arbitrarily. It is something the use case demands mathematically. That demand is now beginning to collide with regulatory momentum and institutional capital in a way that retail investors are not fully prepared for. Voice. Host. Let us talk about who is already positioning and how fast it is happening, because the data here is not soft. An Ernst & Young survey published in January 2026, covering 351 institutional investors, each managing over $1 billion in assets, revealed that 18% of those managers already hold XRP right now, and 25% more plan to add XRP to their portfolios in this calendar year. Not someday, not eventually. This year. Goldman Sachs is currently reporting approximately $154 million in direct XRP exposure, while a large portion of the broader market still debates whether XRP is legitimate. And here is the number that really cuts through the noise. In the same week that Bitcoin ETFs saw $194 million in outflows and Ethereum lost $221 million, XRP pulled in $15.8 million in net inflows according to CoinShares. The two largest assets in crypto are losing institutional money right now. XRP is attracting it. That is not a coincidence. That is a signal, and it is one of the clearest signals we have seen in this cycle. Voice. Host. Now here is a piece of the puzzle that does not get nearly enough attention in the retail conversation, and it comes straight from a comment made by former U.S. Treasury Secretary Steven Mnuchin. When asked about stablecoin legislation, Mnuchin said that stablecoins are a significant step forward for global payments, that they strengthen the dollar's position internationally, and that people outside the United States will find it considerably easier to hold and use dollars through stablecoin rails. What he did not explicitly say, but what is embedded in every word of that statement, is this: the winner in global digital payments is not whoever builds the best stablecoin. The winner is whoever owns the rails those stablecoins move on. And that distinction matters enormously when you understand what Ripple has been building quietly and methodically for years. Ripple's RLUSD crossed $1.5 billion in market cap in its first year, with 1,278% year-over-year growth. That is not a stablecoin launch for marketing purposes. That is a liquidity infrastructure build-out being executed at institutional scale with institutional intent. Voice. Host. There are two regulatory gates in motion right now, and both of them directly determine the timing of what happens to XRP's circulating supply and available float. The first gate is Ripple's National Trust Bank charter. Ripple currently holds preliminary conditional approval for a federally regulated banking license. The moment that approval becomes fully active, Ripple stops being a fintech company operating in a compliance gray zone and becomes a federally regulated financial institution. That single status change removes the compliance wall that has legally blocked Tier 1 banks from directly integrating with the XRP ledger. These institutions have not been cautious or hesitant as a matter of preference. They have been legally blocked. The charter removes that block entirely, and when it does, the calculus for every major bank's treasury and settlement desk changes overnight. The second gate is the Clarity Act, which will follow the arc of the Genius Act through rulemaking and implementation, giving corporate boards, institutional custodians, and compliance officers the legal certainty they need to commit capital at scale. Voice. Host. Here is what you need to understand about regulatory timing, because most retail investors dramatically underestimate how long these cycles take and what that means for positioning. The Genius Act was signed into law mid-last year. We are only now entering the formal rulemaking phase, which includes an 84-page notice of proposed rulemaking and a 60-day public comment period. After that comes implementation, guidance, and eventual institutional commitment. The full timeline from signing to meaningful institutional capital deployment runs 12 to 24 months at minimum. The Clarity Act will follow the same arc. That means the window between now and when both gates are fully open and operational is a window that retail investors have access to, but it is not an infinite window. Every week that passes brings both gates closer to simultaneously opening, and when they open at the same time, what happens to the circulating float of XRP is not subtle or gradual. It is mechanical, aggressive, and driven entirely by the structural demand that gets unlocked the moment compliance teams get the legal green light they have been waiting for. Voice, host. Let us talk about the float compression, because this is the mechanics that most holders have not fully thought through, and it is critical to understanding what happens to your stack when both gates open. Ripple Prime, built on the Hidden Road acquisition, is positioned to clear trillions in institutional volume. G Treasury plugs the XRP ledger directly into corporate balance sheets for cross-border settlement, payroll processing, and supply chain payments. Every dollar of that volume requires XRP to be locked into on-demand liquidity channels, liquidity pools, automated market makers, and institutional custody arrangements. And here's the key detail, that XRP does not return to exchanges. It gets absorbed, it gets locked, it leaves the circulating float permanently for the duration of those arrangements, and those arrangements are being structured for years, not days. Think about what that means practically for someone holding 5,000 XRP today. The float sitting between your position and the institutions that are about to need that liquidity is already shrinking, even before both gates open. After they open simultaneously, the compression accelerates in a way that will be very difficult for the average retail investor to track in real time. Voice. Host. The network effect is not theoretical at this point. It is already operational, and the proof points are stacking up faster than most people are tracking them. RLUSD is already live on one of South Korea's largest retail exchanges, denominated in Korean won. Ripple Treasury is now a certified partner in the SWIFT network, not peripherally connected but integrated at multiple layers deep within the system that moves the majority of global institutional payments. Standard Chartered has projected a $2 trillion stablecoin market by 2028. JP Morgan's internal forecast puts that number between 500 and 600 billion in the same window. Bernstein is modeling 4 trillion by 2035. These are not crypto predictions made by influencers on YouTube. These are banking research desks producing models that executives use to allocate real capital. And the rails those stablecoins are projected to move on are the rails that Ripple has been building while the retail community has been debating whether XRP is real or not. The infrastructure is built, the volume is coming. The question is how much of the float will be left when it arrives. Voice, host. Now, here is the part of this conversation that requires some honesty, because if you have been holding XRP through multiple cycles, you have earned the right to hear this addressed directly. The frustration is real. You have watched legislation get delayed. You have watched the price sit sideways, while every few months a new catalyst gets announced and then gets pushed back. You have heard banks are coming so many times that the phrase has almost lost meaning. And underneath all of that frustration lives a specific fear that nobody in the XRP community wants to say out loud. The fear is not that XRP fails entirely. The fear is that by the time the price actually moves, the institutions will already be fully positioned, and retail holders will become the exit liquidity that funds their profit. That fear is not irrational. It is the exact psychological mechanism that causes retail traders to sell at the bottom of the biggest setups in market history. And it is worth addressing with data rather than dismissing it with enthusiasm. Voice. Host. Here is the data point that directly challenges that fear. XRP's 30-day realized volatility just hit its lowest level of 2026. The price is holding around $2 while institutional inflow data is positive and institutional survey data shows accumulation continuing. Historically, extended volatility compression at these levels before a structural regulatory event does not happen when smart money is distributing and exiting. It happens when smart money is still loading. When institutions are distributing, they need price movement and volume to exit efficiently. Compression is what the chart looks like when patient capital is accumulating quietly and the retail community is distracted by other narratives. The on-chain data, the institutional survey numbers, the legislative timeline, and the volatility compression are all pointing in the same direction simultaneously. That level of convergence across multiple independent data sources is not something that shows up randomly. It is the fingerprint of a structural setup, and the window to be on the right side of it is the window you are sitting in right now. Voice. Host. The holder who wins this move is not the one with the highest conviction during the bull run when everything is going up and the headlines are screaming about new all-time highs. It is the holder who maintained their position during the period of maximum frustration, which is the exact period you are in right now. When the compression theory felt too abstract to act on, when the legislation felt too slow to matter, when the price felt too stuck to justify holding. This is the window that most retail investors look back on and describe as the one they wish they had not overthought. The math is not complicated once you accept that XRP is not being evaluated correctly by market cap metrics. The functional price requirement is not optimism, it is engineering. The institutional positioning data is not speculation. It is published survey data from Ernst & Young covering managers with over $1 billion under management. The regulatory timeline is not vague. Both gates are in active motion with specific procedural milestones happening right now in 2026. Voice. Host. Here at Today Assets Report, we are not going to tell you what to do with your money, and we are not going to give you a price target wrapped in hype and handed to you like a gift. What we are going to do is make sure you have the framework to evaluate what is happening clearly and independently. XRP at $2 handling trillions in annual cross-border settlement volume is not a math problem that resolves itself. The price has to move for the use case to function at scale, and the institutions building their positions right now understand that better than anyone. The supply compression is mechanical, the regulatory gates are in motion, the infrastructure is operational, and the float is already beginning to shrink before the majority of retail investors have updated their mental model of what XRP actually is. You came to this video because something in your analysis told you that the market cap number was not telling the full story, that the institutions were moving differently than the price suggested. You were right. And understanding precisely why you were right is what separates the holders who capture this move from the ones who watch it happen from the sidelines. We will be here every step of the way, covering every development as it lands. Make sure you are subscribed to Today Assets Report so you do not miss what comes next.